My name is Brian Skrobonja, and on this episode of the Common Sense Financial Podcast. This cycle is exactly why so many entrepreneurs never feel they have any extra money. They're always reinvesting. Now, that's not necessarily a bad thing. Investing in your business is critical. But if your goal is to create financial stability, you have to know your numbers and take control of your cash flow.
Well, hey, everybody, and thank you for listening and joining us today. We hope that this podcast can provide you with some insights to help you grow and get closer to your goals this year. But before we get started, be sure to subscribe to this podcast. That way you'll be notified about new content and you'll be able to listen to Brian tackle a variety of different topics. So you can subscribe on Apple Podcasts, Spotify, Stitcher, SoundCloud, pretty much anywhere that podcasts can be found. And all the links to subscribe as well as past episodes are available on the website at brianskrobonja.com. So thanks again for tuning in, and let's get started.
Opportunities are still there.
The attempt at passing down wealth from generation to generation.
Consider the outcome, not just popular opinion.
And the whole teaching there is about preparedness and being ready.
There's a difference between what's real and what's true.
You're listening to the Common Sense Financial Podcast. I'm your host, Brian Skrobonja. Thanks for tuning in, and let's get into today's topic. Today we're doing something a little bit different. Instead of diving deep into a single topic, I'm actually going to take some time here and answer some of your questions, because I receive a lot of messages and I get a lot of questions, and honestly just can't get to them all just due to time restraints. So I thought it would be good to gather some of the most often asked questions and answer them right here on the show. So let's just jump right in and start tackling your questions. The first question is from Kevin in Florida. He asked, you talk a lot about passive income. How do you do this? And is this an annuity? When I talk about passive income, I'm not referring to just one strategy like using an annuity. Annuities can certainly be a part of an income plan, but they're just one tool among many different products. The real key to passive income is creating multiple diversified income streams that aren't dependent on just stock market performance, that can be volatile at times, or even just a single annuity that doesn't allow a lot of flexibility. Most people invest in publicly traded stocks and mutual funds, but what I find is that the private markets offer opportunities for more stable and predictable income streams. That includes things like private lending, where capital is loaned to businesses or real estate developers in exchange for a fixed income. There's also private equity, which involves ownership in businesses that generate long-term cash flow. Real estate is another great option, whether that's direct ownership of rental properties, syndications, or alternative REIT structures that generate consistent income. Hedge funds and managed futures can also slide in there, where you provide professional strategies that aim to generate returns while reducing exposure to stock market fluctuations. Another key piece of the equation is owning cash flow producing assets. Real estate is one of the most well-known, providing both stable rental income and long-term appreciation. But there are also alternative fixed income investments that offer higher yields without the same interest rate sensitivity as traditional bonds. Structured notes, for instance, and private debt investments can also create income from alternative strategies. Now, annuities absolutely have a place in an income strategy. They can provide guaranteed lifetime income similar to what a pension plan does for people, and people have relied on those for years, but they're not the only solution. Passive income isn't just about buying a product. It's about designing a strategy that reduces risk, increases cash flow, and provides a long-term financial strategy. A well-structured plan includes multiple income streams that work synergistically, not just a single stream. Now, when it comes to entrepreneurs, the conversation shifts a bit. Too often, business owners chase multiple ventures thinking they're diversifying, but what they're really doing is spreading themselves too thin. This leads to burnout and underperformance. Instead, the much smarter approach is to focus on a single core business model and create multiple forms of income from that business. For example, a lawn care business might add lawn treatments, fall cleanups, snow removal, instead of launching a completely unrelated venture. A restaurant owner might expand into catering, private events, or even selling packaged sauces instead of opening a separate retail store. A consultant might develop online courses, group coaching programs, or licensing opportunities instead of trying to build an entirely different business. This approach allows entrepreneurs to increase their income potential while maintaining focus and efficiency. The key really is to expand within your expertise rather than chasing unrelated revenue streams. So whether it's investing for passive income or scaling a business, the principle is the same. You diversify smartly, maintain control the best that you can, and keep your money working for you. Next question is from Brian in Arizona. He asked, I have always kept a lot of cash and was wondering how much money I should keep in savings. I have always heard 3 to 6 months of income, but I am way past that, and I'm beginning to think I'm not being smart with my money. Now, that's a great question, and honestly, it's one I hear a lot. The problem with the idea of saving is that it's way too vague. It doesn't specify what the money is for, which makes it hard to determine the best place to keep it. So instead of thinking in terms of just saving money, I prefer to think about storing money with a purpose, and that purpose determines the best place to put it. Most people who ask this question are really referring to what I would call an emergency fund, a chunk of cash sitting in a bank account just in case something unexpected happens. But here's the issue that I have with that. Most true emergencies, when you think about it, what are they? Car accident, home damage, health issue. They're all covered by insurance. And if you have a deductible to cover, that's one thing. But keeping a massive amount of cash sitting idle for an undefined what-if scenario doesn't make much sense to me. If you need money in a pinch, a credit line or a credit card can bridge the gap temporarily, giving you time to access money from a source to get some liquidity, and then you just turn around and pay that credit line off. So the real question is, how much should you keep in the bank? My suggestion, and this is very loose, but my suggestion is around $10,000 in cash. That's not a hard number, but it's a good estimate because that covers most short-term needs without having too much money sitting in an account, earning very little to no growth. And even if you kept significantly more in a bank, most banks limit daily withdrawals anyway. So the idea of needing a huge emergency fund just sitting there is a bit flawed. The real focus should be on where the rest of your money is stored. Instead of following the traditional advice of keeping 3 to 6 months of savings in a low-yielding account, I focus on building wealth while maintaining access to the capital. It's an entirely different paradigm. A specially designed whole life insurance policy, what I call build banking, and I've talked about repetitively on the podcast, is a much better place to store cash because it grows tax-free. It does have some liquidity and continues compounding even when you borrow against it. A brokerage account is another good option for liquidity. It allows you to have better growth potential than a bank and also provides the liquidity that you're looking for. The real problem is that most people are following a broken strategy. They put money into a savings account where it earns almost nothing, or they lock it away in a retirement account where it's inaccessible without penalties and taxes. Neither of these is an ideal way to maintain both liquidity and wealth building. Instead, my approach is to build wealth first while ensuring I have access to cash along the way. That means keeping a reasonable amount in liquid cash for immediate needs, but ultimately making sure my money is working for me, not just sitting there collecting dust. This way of thinking is how financially successful people tend to approach liquidity. It's not about hoarding cash in a bank account, but about positioning money in the right places so you always have access to cash while it's still growing. Here's another question from Jean right here in St. Louis. She asked, I'm a 64-year-old entrepreneur. I have more than enough money, I think, to live the rest of my life comfortably. I have friends who are retiring and have asked when I'm going to join them. This is not something I think about and was wondering if this is common with people you speak with. I appreciate sharing your experience. Okay, so your question is very common, especially among successful entrepreneurs who love what they do and aren't interested in traditional retirement. I hear from people all the time who are financially secure, but they're not necessarily looking for an exit. They're looking for continued purpose and achievement. Retirement, as it's traditionally defined, is a societal construct that has shifted over time. Historically, work was intertwined with life until physical limitations made it impossible. Today, many see retirement as a destination, one of relaxation and leisure. But for those who are purpose-driven, the idea of simply stopping work feels unnatural. I addressed this very topic in a past episode about the evolution of retirement and how societal expectations have shifted. Some people dream of the freedom to sleep in and have no obligations, and that's fine. But I find that many high achievers, especially entrepreneurs, don't find that very appealing. In fact, many find the prospect of fully retirement unsettling. For those who genuinely enjoy their work, money isn't the primary motivator. It's simply a byproduct of doing what they love. The real driver is the experience, the challenge, the impact of what they do. I often hear people say they want to travel or volunteer, which can be fulfilling, but without a true sense of purpose, even those activities can start to feel empty over time. If you're someone who still has value to bring to the world, there's no reason to force retirement just because it's what other people expect. Healthy people are living longer, and spending 30 or 40 years without a meaningful pursuit can feel like a long, drawn-out finish line rather than an exciting next chapter. I'd encourage you to think beyond the traditional definitions of retirement and instead focus on what gives you energy and fulfillment. If that's continuing to work, then why stop? If it's shifting into a new phase of contribution, then lean into that. The key is to design a life that aligns with your personal vision, not someone else's expectations. Next question is from Daryl here. Daryl in Texas, not here because I don't live in Texas, but Daryl in Texas. He asked, I have a mortgage on my home and enough money in my investments to pay it off. I grew up in a household that taught me that debt is never good, and it bothers me to have this mortgage. I have heard you say that you should not pay off the mortgage and would like to hear your reasons for this recommendations. Okay, obviously this is a very common mindset. We hear it all the time that people should be paying off their home, and it kind of gets categorized with debt. But before I dive into this explanation of my position on that, it's important to understand where my beliefs around debt is derived from. First of all, I believe there's two types of debt. There's investment debt and there's consumption debt, and understanding the difference is critical to making a smart financial decision here. Second of all, we must be clear on what the goal we have is. What is our goal for the money? Is it to build wealth? When we're working and making money, are we trying to build wealth and achieve financial freedom, or is our focus to pay off a mortgage? You really can't have it both ways. Investment debt is used to acquire assets that have the potential to grow in value or generate an income. For example, financing a rental property allows you to leverage other people's money while the property appreciates and produces cash flow. And this type of debt, when managed properly, can actually accelerate wealth building because you're multiplying your assets and achieving something you're unable to achieve without the debt. Then there's the consumption debt. This is used to purchase things that do not appreciate and do not generate income, things like flat screen TVs and automobiles. These items depreciate the moment they are purchased. This type of debt robs you of wealth because you're paying for something that is losing value instead of growing your assets. So the key takeaway is that, in my opinion, that not all debt is bad, but it must be used strategically. If debt is being used to acquire an appreciating asset that builds wealth, it could be a powerful tool. If it is being used to fund a lifestyle, to consume, just buy things that decline in value, it can quickly become a financial trap. So many people argue that a home is not an investment because it isn't generating revenue from rents, and I do agree with this sentiment. However, it's important to understand that this is often a large asset, and it's important to know how it impacts your overall financial picture. Here's the primary consideration, and this is worth writing down. A home appreciates in value regardless of whether or not it has a mortgage, which means eliminating the mortgage does not increase the home's value. It simply changes how you hold your assets and can actually result in reducing your wealth. Let's take an example. Suppose you own a home worth $400,000 with a $200,000 mortgage, and you also have $200,000 in an investment account. So if you take the home and the investment account, you have $600,000 in assets that are appreciating. Now, if you take that $200,000 from your investment account to pay off the mortgage, you no longer have that money growing for you. Your total assets have dropped from $600,000 to $400,000, converting your investment into home equity, which I consider a dead asset because, like I've already said to you, the home is going to appreciate regardless of whether or not it has a mortgage. By reallocating assets, you've eliminated the mortgage payment, but at what cost? The time value of money tells us that the $200,000 you reallocated had the potential to compound and grow over time. So even with the money you're saving on the mortgage interest and freeing up that monthly payment, it will take years, possibly decades, to recoup what that $200,000 could have accumulated if it were to remain invested. And the reality is you will likely never catch up to where it would have been had it stayed invested. A smarter approach, which I talk about a lot, is to create an income stream from an already owned, or maybe you need to acquire an appreciating asset that can cover your mortgage payment rather than depleting your resources to eliminate that mortgage entirely. So by keeping the investment capital intact, you allow it to continue to compound, growing while leveraging it to generate cash flow. This way, instead of using your wealth to eliminate debt, you're using it to build even more wealth without losing liquidity or opportunity. Instead of focus on being debt-free, again with good debt, my suggestion is to focus on maximizing assets and their income-producing potential. Paying off a mortgage might feel good emotionally, but it may be one of the least effective uses of capital. The goal should be to keep your money working for you, not to tie it up in an asset that appreciates the same whether or not it has a mortgage. So here's a question from Phil in Utah. He asks, I'm a business owner and my cash flow varies from month to month. How do people commit to saving money when they don't know how much they'll have available? I've been growing my business for 16 years, but I never seem to have excess cash to save. Well, Phil, you're not alone. This is one of the most common struggles amongst entrepreneurs, and I've even dealt with this myself. The challenge is that most of the financial advice out there is geared towards people with a fixed salary, people who know exactly how much they're going to earn month over month. But even they struggle with saving because they often overspend and rack up debt despite having consistent income. So having predictable cash flow isn't the recipe. It isn't the magic pill. Because it doesn't necessarily solve the problem. It is proper management that drives success. The key to overcoming this isn't about waiting for the perfect financial situation. It's about having a system that you're following. That system comes down to two things: maintaining an abundance mindset and knowing your numbers. If you're constantly operating from a place of scarcity, worrying about whether money will be there next month, you'll always feel like you don't have enough money to save. Instead, you have to shift your mindset from month-to-month survival to long-term financial control. And the only way to do this is to get really clear on your numbers. You've obviously been in business for 16 years, so you know how to make money. That's the hardest part of any business. The problem is many business owners make financial decisions based on how much money is in their account at the moment that they need to make the decision. But entrepreneurs need to take a step back and see a broader view of their circumstances. They need to look at their growth rate over the past few years. Have you seen growth over the last 3 years? What dots can you connect to why that growth occurred? Has there been dips in income? If so, why? Were those dips due to something within your control, or were they caused by external factors like a COVID or just an economic downturn? Understanding these trends allows you to plan more effectively instead of reacting emotionally to the month-to-month fluctuations. But much like the stock market, you must examine a cluster of years, not recent performance, when making judgments and decisions. The next step is knowing exactly how much money you need for two things: your personal lifestyle, including taxes, and your business operations, excluding R&D for growth. These are your baseline numbers, and without them, you're just guessing. That's why most entrepreneurs feel like they can't save. They don't know their numbers. I separate R&D because that's an investment in your business, not a fixed expense. This is where most business owners get stuck. When cash flow is good, they tend to pour money into growth, like marketing, hiring consultants, testing strategies. Then when cash flow tightens, they immediately cut back on those investments. This cycle is exactly why so many entrepreneurs never feel they have any extra money. They're always reinvesting. Now, that's not necessarily a bad thing. Investing in your business is critical. But if your goal is to create financial stability, you have to know your numbers and take control of your cash flow. Here's where to start. Just set up a simple cash flow management system. Have an income account where all your revenue flows in, but no bills are paid from this account. Its only job is to receive income. Then set up a tax account solely for setting aside your estimated tax payments, and then have a personal account for your household expenses and a business account for your operating expenses. Once you have those accounts in place, just take your annual business and your annual personal expenses, simply divide them by 12, and then move that amount into the appropriate accounts each month from the income account. The same applies to taxes. Figure out your effective tax rate and move that percentage into your tax account monthly. This keeps you in control of your money rather than feeling at the mercy of whatever happens that month. Over time, what I suspect happens, because I've seen this happen for myself, is that your income account actually starts accumulating a surplus. That surplus can be then used for a structured wealth building strategy in the following year. Look, running a business is complex, and what I've described is just a foundational framework for managing cash flow. It's definitely not the answer for everything long term. There's certainly more advanced strategies to optimize this further, but if you don't start with this simple structure, nothing else is going to work because you're always going to be living in that scarcity and always looking at things month to month. The goal isn't just to make money, it's to build wealth, and that starts with how you manage your cash flow. Look, I believe that most of you listening understand that much of what we have been taught about money is skewed toward oversimplification, and that doesn't always translate to making better financial decisions. There's a thin line between oversimplification and overcomplicating things, but with the right team of advisors who have experience helping clients with more complex situations, you can design a plan that supports your lifestyle goals. Keep your questions coming in, and if you found this episode helpful, please take time to post a review. It means a lot. That concludes today's show. I am Brian Skrobonja. Thank you for listening to the Common Sense Financial Podcast.
Thanks for listening to today's show. If you liked what you heard, be sure to subscribe on YouTube and Spotify so that you can receive notifications when we release new episodes. I'm Brian Skrobonja, and this is the Common Sense Financial Podcast.
Well, thank you for listening to the Forbes Top 10 rated Common Sense Financial Podcast. Before you go, I want to encourage you to jump over to brianskrobonja.com to access the full archive of blogs and podcasts. And if you want to be the first in line to get new content, you can sign up for free on the Brian Skrobonja website as well. If you're not following Brian on all the social channels, we'd love to have you join in on the conversation. Instagram, Facebook, LinkedIn, Twitter, he's there. Lastly, if you've enjoyed listening to today's podcast, or if you have found value in any of our content, help spread the word by sharing our videos, podcasts, and posts wherever you get them. We greatly appreciate it and are glad that you took the time to join us today. Securities offered only by duly registered individuals through Madison Avenue Securities, LLC, member FINRA and SIPC. Advisory services offered only by duly registered individuals through Skrobonja Wealth Management, a registered investment advisor. Tax services offered only through Skrobonja Tax Consulting. MAS does not offer billed banking or tax advice. Skrobonja Financial Group, LLC, Skrobonja Wealth Management, LLC, Skrobonja Insurance Services, LLC, Skrobonja Tax Consulting, and billed banking are not affiliated with MAS. Skrobonja Wealth Management, LLC is a registered investment advisor. Advisory services are only offered to clients and prospective clients where Skrobonja Wealth Management, LLC and its representatives are properly licensed or exempt from licensure. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Billed banking is a DBA of Skrobonja Insurance Services, LLC. Benefits and guarantees are based on the claims-paying ability of the insurance company, not FDIC-insured. Results may vary. Any descriptions involving life insurance policies and its use as an alternative form of financing or risk management techniques are provided for illustration purposes only, will not apply in all situations, may not be fully indicative of any present or future investments, and may be changed at the discretion of the insurance carrier, general partner, and/or manager, and are not intended to reflect guarantees on securities performance. The term billed banking, private banking alternatives, or specially designed life insurance contracts are not meant to insinuate that the issuer is creating a real bank for its clients or communicating that life insurance companies are the same as traditional banking institutions. This material is educational in nature and should not be deemed as a solicitation of any specific product or service. Billed banking is offered by Skrobonja Insurance Services, LLC only and is not offered by Madison Avenue Securities, LLC. Our firm is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by the third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by our firm. References to billed banking, private banking alternatives, or specially designed life insurance contracts are not meant to insinuate that the issuer is creating a real bank for its clients or communicating that life insurance companies are the same as traditional banking institutions. This material is informational in nature and should not be deemed as a solicitation of any specific product or service. Billed banking is not FDIC insured. Billed banking is offered by Skrobonja Insurance Services, LLC only, and is not offered by Madison Avenue Securities, LLC, nor Skrobonja Wealth Management, LLC.
The content of this video is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives. This presentation does not take into account your particular investment objectives, financial situation, or risk tolerance, and may not be suitable for all investors. Information provided is not intended as tax or legal advice and should not be relied on as such. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation.